users of financial statements, stakeholders, is it right? You're talking about the shareholders, potential investors, suppliers, management. You're talking in terms of bank managers, employees, or if we take into consideration, it is nothing but stakeholders. Okay, it is nothing but stakeholders. Ratio analysis, number of ratios calculated, choose the relevant post situation, party, this examination, is it right? It is not that much specific. Okay, you have to make the comments. Is that your answer to section C is analysis should be used the information scenario to produce the reasons. Is it right? To produce the reasons for movements and positions. We will write. The calculations are easy, very easy. Is that you are talking in terms of what you are asked to analyze for? This is what it says. We have to think in terms of what? In terms of performance, in terms of position, in terms of the looks, how it is. This covers in terms of what? In terms of share prices. Is it right? In terms of share prices, in terms of dividends, earning per share. Is it right? We are talking in terms of capital, working capital, long-term solvency ratios. Is it debt equity ratios? If you take into performance, is it right? If you take into performance, you are talking about profit margins, return on capital employed, net turnover ratio. Is it right? These are the basic things which we are going to based on performance wise, based on position wise, and based on investors wise. Is it right? The ratios related to performance is revenue, related to revenue. Is it that sales? Is that you have the gross profit margin? Is it right? See, this is, you know the formulas, yes or no? Tell me fast.
I need to revise it.
Okay. Is that wherever the formulas are there, yeah, I will put like this. Okay, so that it will be easy for you to get in touch. Is that this is little bit now. This helps you. Okay, this helps you in writing the report. Okay, that is the only thing. If you read this, you will get some content. Okay, some resources. How the selling prices will affect sales mix affected the gross profit margin. Is it right? Gross profit margin, you have to make it sure. Is that you have to make it sure. It is nothing but what? Sales minus cost of goods sold. Is it? Just you have to analyze these three values. You will get lot of information with respect to that. A good way of analyzing gross profit margin is ask yourself, any reasons of selling price has been changed? Is it right? Anything has been happened to the cost? Anything happened to the sales mix? That much you should be indication. Is it right? You have to compare gross profit intercompany, within the company, within the years, with outside the companies, industry. Is it right? The same thing. You have the operating margin. This is the second formula. Okay, this is the second formula. Is it right? This is the second formula. I will write this. Okay, I will write this. This is the second formula. Okay, and this is the first formula. Is it? This is the first one. And how operating expenses, operating margin is nothing but all administration expenses, operating depreciation, all this comes in the operating profit margin. Okay, packing, commission. Is it right? These things will come. Now, this is the third one. Okay, this is the third one. Is it right? This is the third one. What is the return on capital employed is profit. Return on capital employed is profit divided by profit before interest and tax. Is it right? Profit before interest and tax divided here, yeah, profit before interest and tax divided by capital employed into 100. Okay, how much we have invested and how much we are getting the returns on our investment. Yeah, this is with respect to what, which one is that, this formula? This is third one. Okay, this is third one. This is fourth one. Is it right? This is fourth one. This is profit after tax divided by equity. Is it right? This is the fifth one. Sales revenue. Is it? Sales revenue divided by capital employed. This is the return on capital employed, profit margin, profit before tax. This is which one? Put the number, fifth one. Is it right? Fifth one. It is the sixth one. Is it right? See, here it is there. See the things. Profit before interest and tax divided by sales, is it right, into sales divided by capital employed. Is it right? Sales divided by capital employed. Or these two will get cancelled. Okay, these two will get cancelled. This is cancelled, this is cancelled. Fine. What will happen? It comes to how much? Profit before interest and tax divided by capital employed. Sixth one. Okay, sixth one. This is working capital. Is that this is when you are talking about the position, we are talking about the working capital. Okay, working capital is current assets and current liabilities. Is it right? Current assets and current liabilities. It is there. See, current assets and current. What is the number? Tell me the number. I have to, I should know. 6. It is 7. Is it right? Maximum you have 12. I think so. Maximum 12. 12 only. 7. Okay. This is 8. Is it right? This is 8. This is 9th. Okay, this is 9th. This is 10. Where is the formula? This is 10. Okay, receivables. We will do all the things we will do. Okay, this is 11th. Where is the formula? Formula is here. Is it? This is 11. Listen, once class is over, just you go through these slides. Okay, you go through the slides. Every lecture you have these points. Okay, just have 11. Fine. Okay. Slowly I will tell you. What inventory talks about. Inventory talks about, see, without theory we cannot do calculations. You can understand now how the things will work. Is it right? What is the inventory turnover? Inventory turnover ratio talks about how much time we are taking to convert inventory into cost of sales. Is it right? How much time we are talking in terms. There are two things. Either you can express, yesterday we got struck it, if you remember rightly. Is it right? Either you are talking in terms of days or you are talking in terms of what? In terms of times. Is it right? inventory turnover ratio should be less. Is it right? Inventory turnover ratio should be, it should be number of days. Is it right? Number of days should be less. Is it right? Should be less. And if you take turnover in terms of times, is it right? It should be more. Is it right? It should be more. Likewise, receivables should be, what receivables should be, collection period should be less. Is it right? Collection period means you have to recover quickly. Is it right? Collection should be less. Is it right? Collection period should be, you have to recover as quickly as possible. Okay? In terms of that. Quick ratio is nothing but the standard is 2:1. Is it right? Sorry. Quick ratio is not 2:1. It is 1:1. Current ratio is 2:1. Is it right? Means how much you should have cash with you. Is it right? The current assets minus inventory divided by current liability. How much you should have cash, ready cash. Is it right? Quick ratio is nothing but, we are talking in terms of what? In terms of ready cash. Whereas you have the current ratio. Is it right? Current ratio is nothing but current assets minus current liabilities. Is that what they say it is a working capital ratio also. Is that? They say it is a working capital. How much it is there? It should be 2:1. Okay. That's all. Is it right? That's all. We will use the formulas applicable, and most importantly we have to write. Okay. Most importantly we have to write as such. Okay. Fine. Fine. Now, one, two, three, four. 1, 2, 3, 4, 5. Okay. $800 by 1,500, 7,000 by 100. Is it? 800 divided by 1,500. 800 divided by 1,500 into 100. Okay. And the second one is 700 divided by 1,000. 700 divided by 1,000 into 100. How much you will get?
$70.
How much?
100.
800 divided by 500, 1500, 53.3. Okay,
Yes. And the second one is 70.
53.3. Okay, and the second one is 70. Fine. Next, operating profit margin. What is the formula for operating profit margin? We operate here. What is the formula for operating profit margin? Profit from operation divided by sales into 100. Profit from operations. Profit from operations. Profit from operations divided by sales into 100. Okay, sales into 100. How much is the profit from operations? How much is the profit from operations? Profit from operations is 400. Is it right? This they have mentioned here like this. Okay, this is nothing but 400 and 340. This is profit from operations. Is it? Sales is how much? 1500. Okay, okay. How much? 400. Profit from operations is how much? 400 divided by 1500 into 100. Here how much is there? 340 divided by 1000 into 100. How much you'll get?
26.6.
26.7, and here 34%.
Yes.
Is it right? Here 34%. Fine. Next, what is there? Return on capital employed, ROCE. Is it right? Return on capital employed. The third one, ROCE. Is it right? Profit before interest and tax divided by capital employed. Is it right? Capital employed into 100. Okay. Now, how much is the return again? Profit before interest and tax. I will write in a good way. Okay. I don't. Profit before interest and tax divided by capital employed, is it right? Into 100. Is it right? Capital employed is how much? How you calculate capital employed? Any idea?
No.
Always, is it right? This is called as a capital employed. Equity plus retained earnings. Okay, equity and retained earnings. Okay, is a capital employed. You have two approaches. Is it right? Otherwise or total assets. How much is the total assets? Total assets is 2580. Is it right? 2580 minus non-current liabilities. Non-current liabilities is there? No, nothing is there here. Okay. Now current liabilities. Is it right? How much is current liabilities? 1070. Okay. Minus. Is it right? Minus 1070. 10151. Either you do like this or you do like this. Answer will be same. Okay. Answer will be same. This is the assets approach. Is it? This is the assets approach, and you have the liability approach also. Okay, profit before interest and tax is how much? Profit before interest and tax is 400. Is it right? 400. Is it 400 divided by 1510 into 100? Okay, 400. Next, what is the 340? 340 divided by 1420 into 100. How much you get?
$26.49.
To 26.5. And here
23.9.
23.9. Okay. Now what they ask here? They're asking you the assets turnover. Is it right? What is that? A net asset turnover. Is it right? Net assets turnover. Point number 4. Is it? Net asset turnover. What is the formula for net assets turnover? You have the net assets is nothing but same. Is it right? This is net assets. Okay. This is what? This is net assets. Okay. This is net assets. For the other period, total assets are how much? Total assets are how much? 1900. Is it right? $1800. Is it? Oh. 1800. You have non-current liabilities. You don't have non-current liabilities. 0. Okay. You have current liabilities. How much is the current liabilities? Current liabilities are how much? Current liabilities are 380. 0, 2, 7 minus 3, 4, 1420. Is it right? 1420. In either case, you will get the same answer. Okay. In either case, you will get the same answer. Is it right? Net asset. First, write the formula for that. Okay. Net assets turnover ratio is how much? Net assets turnover ratio is, what is the formula? Formula is sales divided by net assets. Is it sales divided by net assets? This will be in times. Okay. This will be, answer will be in times. Okay. Answer will be net. Sales is how much? Sales is 1500. 1510. That's all. Okay. How much you will get? Sales is 1000. Net assets is how much? 1420. How much you will get?
0.993.
Okay, next.
$0.70.
0.70. Okay. Current ratio. Current ratio is nothing but current assets divided by current liabilities. Okay, this you put dash, okay, your current ratio. You can write like this, nothing will happen. Current assets divided by current liabilities. Okay, current assets are how much? 700. Is it right? So current liabilities are how much? 1070. Okay, 1070. How much you'll get? Here current assets is how much? Current assets is 200. Okay, current liabilities how much? 380.
0.65.
0.65. Okay, 0.65 is to 1. Okay, you have to write like this. This is current asset, this is current liability. 1 is always current liability. Okay, 1 is all 200 divided by 380.
0.526.
0.5. Can I put 5? Okay,
Yes.
fine. Next, quick ratio. Quick ratio is current assets minus inventory. Is it divided by current liabilities? 700 minus 300. Okay, 700 minus 300, 1070. It comes to how much? 200 minus, God is 200 minus 100 divided by 380. How much you'll get?
0.37.
Okay,
0.26.
zero point 0.37. 0.37 is to 1. Always you have to write is to 1. Okay, 1 is always, and 0. How much? 0.26 is to 1. Okay, what is the next one? Next one is inventory collection period. Is it right? Next one is what? Inventory collection period. Is it? Inventory collection period. Inventory is how much? Inventory, is it right? Inventory formula. Inventory divided by cost of sales. Is it right? Cost of sales. Is it? Inventory divided by cost of sales into 365. Okay, how much is the inventory? 300. Is it right? How much is the inventory? 300 divided by cost of sales is how much? They have given cost of sales 700, 300. Okay, 700 into 365. Is it 100 divided by 300 into 365. How much you get?
156.4.
Huh?
156.
Next.
$121.6.
I will take 122 days. Nothing will happen, okay? Nothing will happen. Don't worry about it. Next, accounts. Next, accounts. What is it? Accounts receivable collection period. Is it right? Accounts receivable collection period. Is it right? Accounts receivable collection period. How much is the accounts receivables? Let's see, accounts receivables divided by sales. Okay, divided by sales times 365. Okay, 365. 400 divided by 1500 into 365. Here how much is there? Receivables 100 divided by 1000 into 365. Tell me answer please.
97.3.
Yes, 97. Don't say 3. Days na? Only in percentage you can take. Okay, next. How much it is?
37.
37. Okay. Now, accounts payable period equal to accounts payable divided by cost of sales times 100 times 365. Okay, times 365. It comes to how much? Accounts payable is how much? Accounts payable is 370. Is it? Accounts payable is how much? 370 divided by 700 into 365. Is it? How much is there here? Accounts payable only 70. Okay, only 70 divided by 300 into 365. How much you'll get?
193.
193. Good. Next.
85.
85. Okay. Fine. Now it's up to you. See, I am giving you only an idea how to write. Okay. I am going to give you only an idea how to write. In the examination, your understanding makes the difference. Okay, don't memorize this. Okay, don't memorize this that I have to write like. Don't force yourself. You can write. I told you, everybody will write in their own way. Okay, everyone will write in their own way. So you also write in the own way. I am giving you an hint. Okay. Now what happens? Just make it a point. Sales, is it right? Sales or sales revenue. Sales revenue has been, is it right? Has been increased by how much? Has been increased by 50%. Is it right? How much? How it is increased? 50%. 1,500 minus 1,000 divided by 1,000. Is it? Current year is 1,500. Current year is 1,500. Last year is 1,000. last year is 1. How much it has been increased? It has been increased by. Now gross profit is how much? You write. You have to write. Only thing is you have to write as per your understanding. That's very. Gross profit has been decreased. Is it? Gross profit has been decreased. 70% was last year. Is that? Gross profit has been decreased. Is that? 70% was last year. This year is how much? It is only 53 point. Is it right? Is it? Maybe there are so many reasons. Is it? Is it? What happens next? What you have to write? The gross profit. Is it? The gross profit. The gross profit margin has been decreased from 70% to 53.3%. The reason may be, is it? You have to write the reason may be, is it right? Due to, is it? Is it due to less selling price? You have to write anything, is it right? Less selling prices, okay? Or is it? Less selling prices, fine, okay. Next, to increase the market share of the product. Write something. You have to write. I am writing something, okay, relevant, is it right? It should be relevant to that. You write anything. Wherever is possible, give numbers. Is that easy scoring place? Net profit has been decreased. Operating profit decreased by 34% to 26.5. Is it right? Is it? The operating profit margin. The operating profit margin has been decreased from 34% to 26.6%. How much is there? From 26.5%. No, 26.7%. Okay, 26.7%. Is it? Is it right? 26. Then both gross profit margin and operating margin ratio has been decreased in both the years. Is that in both the years? Now, return on capital. Return on capital increase. See the things, mashallah. Return on capital, how much is it? 23.9, 26.5. Is it? Is it a return on capital has been increased? Fine. See, I will write the numbers, okay? 1, 2, is it? 3, is it? 4. The return on capital employed, is it? The return on capital employed has been increased from 23.9% to 26.5%. Okay, 26.5%. Now, the reason may be one of the reasons for what is the capital. Maybe you have improved your capital, you used your capital. Capital is nothing but net assets, is it right? You use the capital. Yeah? Maybe the reason may be capital employed in terms of assets has been effectively used. Okay, effectively used. You write something. Okay, relevant. Something means not something. Relevant. Okay, that's very important. Fine. Now net assets are how much? Net assets. Net assets is also improved. Is it right? Net assets has also improved. 0.70 and 0.993. The net assets has been improved because of effective utilization. You write in your own simple English. Okay, just okay, you write your own. Any doubt, any words you have I doubt, let me know. Effective utilization of net assets. I am trying to write in the simplest of the simplest English. Okay. Fine. Okay. Next. What we have done, we have calculated current ratio. Is that current ratio has been increased? Okay, current ratio has been increased. Both current ratio and quick ratio are below the standards. Below the standards, but improve over the previous year. Inventory is how much? Inventory 122, 156. Inventory has been increased, is it? It's not a good sign, okay? That means you are, is it? Inventory.
Can you read what you wrote? Both current asset and quick ratio?
Current ratio has improved during the year 2002.
Okay.
Both inventory and receivables has been increased. Because you see the things. Is it? One minute. You see the receivables. Is it not? See the things. Here what happened? From 100 to 300. Is it right? From 100 to 400. What you write, it should make sense. Both inventory and receivables has been increased. Both current assets and current liabilities are below the standards 2:1 and 1:1. Is it? Both current ratio, this is 2:1. Is it right? This is 2:1. This is quick ratio is 1:1. Are below the standard but improved over a period of time. Okay. Inventory is how much? Inventory, they are holding inventory 122 days and 156 days. Is that inventory turnover days has been increased from 122 days to 156 days. It means that inventory is held by the firm for more number of days during the current year. You should not keep more number of days. You have to get inventory and you have to sell it as quickly as possible. Okay. What is that next one? Receivables. Is it right? 37 days. No, la ilaha illallah. 37 days and 97 days. Just imagine, is it right? Just imagine. Receivable days are increased from 37 days to 97 days. It means that the collection period from the debtors, has been has been increased abnormally. Result has been increased abnormally. Last one, payables. Is it payables? How much is the payables? 85,193. Allah mia. Payables, payment period. Payables payment period has been increased from 85 days to 193 days. It means that the payment is taking a longer period of time to settle the balances. Okay, conclusion. Overall, see the things. Bank overdraft. How much? 590. Last year also bank overdraft. This year also bank overdraft. Overall, the firm position is heavily dependent on bank overdraft. Previous year bank overdraft is much lesser than the current year. Are you clear about this?
Can you repeat again the conclusion?
Overall, the firm position is heavily dependent on bank overdraft. Previous year bank overdraft is much lesser than the current year. Is it right? Much lesser than the current year. See how much is the bank overdraft? Bank over last year it is 210. Okay. This year it is how much? This year it is 590. Is it okay?
Yes, it's okay.
Fine. Next. Here I will see here, see there is, yes, tell me please. They gave you a very simple formula, debt divided by debt, debt divided by equity, or percentage of capital employed represented by the borrowings. Is that? See, there are two things. Is that? I will write it in a short way. Is that debt divided by debt plus equity. Okay? That is the simplest way. Don't complicate the things. People will complicate so much. Is it right? You have this one. Debt divided by, or either you can take A or you can take B. Okay? Gearing ratio. Interest coverage ratio. Is it? Interest coverage ratio is nothing but, why we have not put the numbers here? Profit before interest and tax divided by interest payable. Is it right? Why we have not put numbers here? This is 11. Okay? This is 11. This is 12. Okay? This is 12. And this is 30. See, is it? Why we calculate this? Is it right? What is the reason calculate this? See, whenever the company have difficulty financing its debts, its profits will fall. Okay? See, why we do this? Why we do this? Because what will happen? We'll take loans. Is it right? When we take the loans, what happens? We will pay interest. Is it right? Bank is interested to know whether you can pay interest or not. Is that? Bank is very much interested. First they want interest, then they think about principal. Now what happens? You are comparing. Is it right? You are comparing profit before interest and tax divided by interest expenses. Take this small formula. Okay, both are same. There is no technically no difference between these two. Is it right? But we have to put like this. Is it right? Over trading. What is it? We will do this. What we will do? We will take gearing ratio and we will take interest coverage ratio. Over trading arises. Is it right? This will be there in MCQ. Okay. This will be there in MCQ in section A. Over trading arises when company expands its sales rapidly without securing long-term capital. Means you what happen overtrade, the name itself says, is it right? The name itself says you invest less, but you want to do the more business, is it right? It cannot happen. You cannot say that I will invest 100 reals and I will do the business for 20,000 reals, is it right? If somebody does this business like this, investing 100 reals and doing the business 10,000 reals, it is nothing but the overtrading. Okay, what the symptoms, what will happen, the inventory will increase, is it? Means what happens, your sales is increasing but your inventory is not going to match, is it right? What happens in most of the cases, your sales will boost up the things, and your inventory should also match up according to the sales of the system asset. Your receivables will also increases, possible more than. What will happen? See the thing, when the sales is increasing, is it right? When the sales is increases, it says that your receivables will also increases. Now what happens when you do the things, is it right? When the sales is increasing by 100, the receivables will also increase by 100, okay, or 90, okay, with not 100, assume it is 100, okay. Now what happens in difficult situations, your sales is increasing how much? Your sales is increasing by 100, is it? Your receivables will be increased by how much? 500, is it? Extraordinary, is it? No, it is not like that. It is not like that. 1 minute. Receivables increasing possibly more than proportionately to the revenue. See the thing. Inventory increasing possibly more than revenue, is it right? Possibly more than revenue, is it right? Means what happens? Sales, is it right? Sales revenue is increasing, is it right? Sales revenue is increasing. Sales revenue is increasing. Sales revenue increases by 100. Now what you are doing, is it right? What you are doing, your inventory will also increases. You are expecting that the sales will increase by 100. Is it right? The sales will increase by 100. In the moment you think like that, is that you will get more inventory. Is that you will get more inventory and you will invest. You will invest in the inventory. Is that? But the proportion, the matching is how much? It is almost 10 times. Okay, it is almost 10 times. We should not do that. Is that? That is what overtrading talks about. What the overtrading says that, okay, if sales is increasing by 10%, you increase your inventory by 10%, because inventory is you should not block your amount in the inventory as such. Otherwise what will happen? Your current ratio and quick ratio get affected, is it right? Because of one value, other ratios will have the related ratios, is it right? Other related ratios with the inventory, is it right? With the inventory will have its impact as such. In the same way, receivables increasing, is it? Receivables are how much? Receivables are increasing by 1500. What you do? You are saying that you are expanding the sales revenue rapidly. Is that when you are expanding your sales revenue rapidly? Is that assume that you are expanding sales? Is that last year sales is going to be 200? Is that last year sales is going to be 200? This year sales is going to be 500. Is that right? This year sales is going to be 500. Now, what happens? The sales is increasing. The moment sales will increase, what will happen? Receivables will also increases. Is it? How much receivables are increasing? Assume that receivables will increase by how much? 400. See, this is very sensitive area. Okay, this is very sensitive values. When you see, instantly your sales should not increase. Is it right? If your sales is increasing, definitely it will not going to match your last year performance. Is that? It is not going to match your last year performance. Whenever there is an increase or decrease in any ratio, get my point? Whenever, is it? Whenever an increase or decrease in any ratio, is it right? Any ratio, any value, I will not put as a ratio, I will put it as a any value. Is it right? Any value, it will have impact. It will have impact on both ways in relevant, is it? In relevant ratios. That is the overtrading. Overtrading is you are aggressively selling the things. Is that? You are aggressively selling the things. When the moment you say, see what happens? If you have good, assume I will give a very simple example. Whenever there is a sale, is it right? What happens during the sale? People will buy more. Is it right? People will buy more. Now, when people are buying more, what is the responsibility of the seller? The responsibility of the seller is the inventory should also increase. Is it? The inventory will also increase. Now you have aggressive sales. Is it right? Now what happens if your people are using credit card? What will happen? Your receivables will also increases. Is it? Your receivables will also increase. Automatically there is a mismatch between sales and the inventory, between sales and the anything happens, there will be a mismatch. Then that concept is called as overtrading. Cash and liquid assets are declining. Is right? Cash. What will happen? You are investing in inventory. Automatically, what will happen? The cash balance will decrease. Yeah, cash or bank, both are same. Is it right? Trade payables increase. Means what happens when cash is decreasing? There is a insufficient. Is it right? There will be a insufficient amount to pay out. Is it right? To pay out whom? To pay out to payables. In simple words, in very simple words, overtrading is nothing but mismanagement of cash. Overtrading is nothing but mismanagement of cash. You are not, see what happens. The rule says that the accounting rule says that debit should be equal to credits. Is that the accounting rule says that the debit should be equal to credit? That's all. That is the bottom line. You do anything, that principles should be correct. First thing, and the totals has to be correct. Is it okay?
Yes, it's okay.
Here I have missed one question here. Okay, I have not done this. Now I am realizing. earning per share. Is it right? Earning per share. Earning per share is nothing but profit after taxes. Is it right? Profit after taxes divided by number of equity shares. Is that is covered in the? Is it? No, it is not covered. Where it has been covered? No. Chapter. No. Is it? See, I will write here. EPS is nothing but profit after taxes divided by number of shares. Is it? Next, another important ratio. Is it right? Another important ratio is price earning ratio. Is it? Another important ratio is price. This they will ask you at any cost. Is it right? Price earning ratio. Simple. Market price divided by earning per share. Is that market price? See what is the price earning ratio? What it reflects? See, assume you have invested how much? You have invested 100 reals. Is it? You have invested in 100 reals. Now what happens? You will evaluate how much this 100 reals is earning. Is it? How much this 100 reals is earning, and what is the market price? We'll see, yes, as simple as that. If I am saying that I have invested 100 reals in the shares, I will compare what is the current market price and what is the earnings it is earning. Is it right? Means I will compare, and this is one of the ratios which will be tested again and again, and this ratio will be in form of what? In terms of times. This is very important. Some ratios are in percentage, some ratios are in proportion, some ratios are in days, and some ratios will be in times. People will calculate how much is the current share price, is it? What is the current share price, and how much you are going to pay dividends. Okay, how much is the? See, there are two things. One is dividend yield, one is dividend per share. Dividend per share is nothing but dividend paid divided by number of equity shares. Is it? What is the dividend yield? Dividend yield is nothing but what is the current price. Is it? If the current price increases, automatically what will happen? If the current price is increasing, the dividends will also expect, the shareholders expect that the dividends will also increase. This is the relationship between what? This is the relationship between the available, what is the amount of profits available, and what is the amount of dividends payable. Okay, we'll do that. We'll make it a point. Okay. Now, September 30th September 2007. Fine. What they have mentioned, they have not mentioned anything, is it right? They have not mentioned anything. Okay. Okay, no problem. Is it right? Fine. Which year they have given? They are given for 2007. Is it right? They given for 2007. 2007. Where is the statement of profit and loss? 2007 and 2006. Okay. They are given what? They are given for 2007 and 2006. Revenue. Okay, 2007, 2006. Statement of profit and loss account. Foot results. Is it right? Summarize the recently issued financial statements of Hoof Limited, a listed company for the year 30th September 2007. Fine. On October 30, 2006, yeah, is it? On October 2006, Hoof purchased 100% of the 100 million, is it right? Assets of the Foot Limited. To finance this, Hoof is issued how many shares? 100 million notes they have issued. Is it right? This is like a bonds. Is it? Notes issued. Fox Foot results for the year 30th September 2007 is there. This is the Hoof. Is it right? And this is the, where is that? Okay, Hoof on 1st January, on 1st October 2006, Hoof purchased 100% of the net assets. Fine. Okay, fine. We have to calculate gross profit margin. Is it right? How much is the gross profit margin? Gross profit margin is how much? 50,000 divided by 250,000. Fine. 2007. Is it right? 2007. And net profit margin is how much? Net profit margin is okay. No. What they are saying is there is a summarized balance sheet of Hoof Limited. Is it right? Here also they gave. Is it? We hear the Hoof purchased another company. Is it right? On Hoof 100% of net assets of whom? Foot Limited. Is it right? To this finance they have issued 100 million 8% shares. Is it? This is the results of Foot results. There are two different companies. Okay, Foot results. Foot results are how much? It is in profit for the period they mentioned. Is it right? The following they have mentioned this one: revenue, gross profit, operating expenses. Now, with this we have to manage the things. Is it right? With this, the Foot paid no dividends during 2007, but Hoof paid a dividend of 10 cents. Is it right? Fine. Parent company has paid 10 cents per share. The following ratios has been calculated for the Hoof for the period Hoof for the year ended 30th September 2006. Is it right? They gave you a gross return on capital employed is 7.1%. Gross profit margin is how much? 16.7%. and net profit before tax is how much? 4.4%. Calculate the equivalent ratios, means both you have to calculate, is it right? Including the results of food, excluding all effects of purchase of food, analyze the performance, analyze the cash position. Okay, good. Equivalent ratios, including results of food. Is it right? Including results of food. Okay, including results of food. A is what? Equivalent ratios. Is it right? Equivalent ratios. Including food 2007. Okay, yeah, fine. Now we can get. They have purchased when they purchased on October 1st, 2006. They have purchased when the October 12th, October. No, they have given what? They have given it on 2007 and 2006. Is it right? 2007 and 2006. 2007 means it includes, is it right? 2007 means what is the date is important, is it right? Just I'm 30th September 2007, is it right? 30th September 2007. Now 30th September 2006. Yes. 30th, this is why it's we are very 30th September 2006 means when they have purchased, on 1st October 2006. Okay. Now this is the point of that's why it's taking. We have to understand the dates. Is it right? Now when they gave this includes what? This includes 2007 means this includes the results, including foot of 2007. Okay. Now gross profit margin. Should I write formula or should not? I should not write formula. Tell me fast.
No need to write.
Okay, fine. Is that 50,000 divided by 250,000 into 100. Is it 250,000 into 100? 2007. It comes to how much? 20%. Is it right? 20%. Next, net profit. Is it right? Net profit before tax. Net profit before tax. How much is there? 16,000 divided by 16,000 divided by 250,000 into 100. How much we'll get?
6.4.
How much? 6.4. Okay. Now, return on capital employed. What is the formula? Profit before interest and tax. I will write here. Profit before interest and tax divided by capital employed. Is it right? Profit before interest and tax. How much is there? How much is profit before interest and tax?
16,000.
How much?
16,000.
Before interest and tax.
Yes, before.
Before interest and tax.
26,000. Minus 26,000.
Before interest and tax. Profit before interest and tax. How much you will have here?
24,000.
24,000. You have to add, okay? Here, right? You have to add. Is it right? 24,000. Capital employed is how much? Capital employed is how much? Is it right? Capital employed is how much?
114,000.
Capital employed. See, capital employed. Is it right? Capital employed. It will not change, okay? It will never ever change. This is the equity approach. I have given you the assets approach also. Is it right?
Yes.
What is the assets approach? First tell me. Total assets minus current liabilities. Okay? Total assets minus current liabilities. Total assets are how much? Total assets are how much? 258. Is it right? Total assets are how much? 258. Is it 258? Yes or no? 258. Is it right? Now, current liabilities are how much? Total of how much? 17 plus 23, 40, 44.
$214,000.
214,000. Fine. Liabilities approach, equities approach is what? Total equity. Okay, total equity. Total equity is how much? 114. Is it right? Less non-current liabilities. How much is the non-current liabilities? 100. How much is there? 214. Why I am doing this? You do it in this way or you do it in that way. It makes no sense. Okay. How much is the capital employed? 214. Okay. How much is the capital employed? 214. Divided by 214 into 100. How much you will get?
$11.2.
11.2. Is it right? 11.2. Now, see the things. Why we have done this? We have done, is it right? How much is the capital employed for 2007? Is it? 2007 is how much? 11.2. Is it right? Gross profit is how much? Gross profit we have calculated how much? 20%. Net profit is how much? 6.4%. Is it right? This is calculated. Is it right? This is calculated. What we have done? See the thing. See the things. Is it right? We have done what? Including the results. Is it right? We have done including the results of food. The second one is what? Excluding all effects of excluding. Is it right? Excluding all effects. Fine. If we take into consideration point number 2, excluding all effects of who for food, all effects of food, is it right? All effects of food, is it right? We have to take what? We have to is it? Excluding all the effects of food, is it right? Now, how much is there? One minute. Okay, see the things. Is that 7? How much is the excluding food results? 70,000 is there, 40,000 is there. Is it right? Operating expenses 8,000 is there. Is it right? Now, what you have to do? See the things. Just have. Is it right? Redraft the balance. Redraft the statement of profit and loss account. Because why you are redrafting the statement of profit and loss account? We have to exclude. Is it right? Exclude all effects of what? Exclude all effects of food asset, profit and loss account. Okay. Now, when you redraft all the profit and loss account, exclude, we have to reduce it, is that we have to deduct it. Particulars amount, is it? Particulars amount. Now, how much including how much? Is it right? You have the revenue. Is it right? We have the revenue. How much is revenue? Revenue is 250,000. Okay, minus food revenue. Is it right? Minus food revenue, because we want to exclude it. We want to exclude it. How much is the revenue of food? 70,000. Is it right? How much is the revenue of food? 70,000. If you exclude it, the revenue of after excluding is how much? This much. Next, less cost of sales. Is it right? Less cost of sales. Cost of sales is how much? 200,000. Is it right? What is the food cost of sales? Is that food cost of sales is how much? 40,000. Is that how much is the food cost of sales? It is the 40,000. It comes to how much? 160,000. Is it? Gross profit is how much? Gross profit is 20,000. Is it? Gross profit is now. After gross profit, what is there? Operating expenses. Is it right? After gross profit is there? Operating expenses. How much is the operating expenses? 26,000. Okay. What is the food operating expenses? 8,000. Is it right? Food operating expenses are how much? Food expenses is how much? Food expenses are 8,000. Is it right? Exclude it. Is it right? Exclude it. It comes to how much? It comes to 18,000. It comes to how much? 18,000. What is the profit? You have profit before tax. Is it? You have profit before tax. See, why you are doing this is, see, you want to know, is it right? How it is going to have impact on the financial statements. What is the profit before tax? Any idea? See, how much they have mentioned here. What is the profit before tax? What is the profit before tax? 25%. Is it right? How much is it? 25%. Less tax. Is it right? At the rate of 25%. Fine. At the rate of 25%. How much is there? It comes to 500. 1,500. Is it right? 1,500. Now, is it right? Now, what you have to do? You have to calculate gross profit. Is it right? You have to calculate gross profit. How much is the gross profit? Is it? How much is the gross profit? 20,000. 20,000 divided by 180,000 into 100. It comes to how much?
$11.1.
11.1. Next, which ratio we have calculated previously? Same ratios we have to calculate. Is it? Net profit before tax. Is it right? Net profit before tax. Net profit before tax. How much is the net profit before tax? 2000s, is it right? 2000s, is it 2000? What is the sales? Sales is in times 100. It comes to 2 by
One
how much?
1.1.
1.1. Return on capital employed. Return on capital employed. How much is profit before interest and tax? 2000. Is it right? Profit before interest and tax is 2000. Now we have to be little bit careful. Is it right? We have to be little bit careful with respect to what? With respect to the capital employed. How much is their capital employed? How much is the capital employed? 1 minute. One minute. How much is that? 12 million is a profit for the year. Is it right? 12 million is the profit year. Is it right? 12 million plus how much is that? Hoof how much? Hoof is how much? One profit before tax. Is it? Okay. Hmm. Okay, 1 minute. Fine. See, I will put the numbers here so that it will be easy for you. Okay, this is A. Okay, is it closing working note 1? Okay, working note 1. Okay, working note 1. Closing retained earnings 2007 A. How much is the closing retained earnings? Closing retained earnings is 14 million, or it is in thousands, or it is in thousands. Okay, fine. Next, you have 14. Is it right? Next, minus, is it right? You have that profit for the period, is it right? See, from the closing retained earnings, we want to know the excluding. We have to exclude the profit of food results. Is it right? This is point number B. This is not the profit of Hoof Limited. This is the profit of Foot Limited. Okay, minus foot profit current year. Okay, current year. How much is it? Current year. How much? This put it as B. Okay, how much? 16,500. Is it 16.5? How much you'll get? 2.5. It is minus. Okay, is it right? It is minus. Now find 9s1. Is it? See the things. What is the? This is the hoof. Is it? See what happens. Is it? What happens? This is the Hoof Limited. See. Is it? What is the difference here? Difference is how much? Difference is plus 6,000. Is it? Difference is plus 6,000. You take the retained earnings. Is it right? You take the retained earnings. Is it? Retained earnings is how much? See, last year profits are how much? Last year profits are 6,000. This year profits are how much? 12,000. Fine. This year profits are how much? 12,000. The difference between the last year profits and this year profits is right. Is the increase in retained earnings. Is right? It is the increase in what? It is increase in the retained earnings. How much is there? The increase in retained earnings is 6,000 plus. Understanding my point? Getting see the thing. The issue is we have to exclude. We have to exclude the profit of. We have to exclude the profit of Foot Limited. Okay. We have to exclude the profit. Hoof Limited profit is how much? Retained earnings are how much? 14,000. Fine. In this it has been included. Is it right? Because of 2006. How much is there? 16,000. Is it right? 14 million minus 16.5. Now what you have to add? You have to add the difference. Is it right? Little bit challenging. Is it right? Very sensitive. Is that you have to add the difference in profits. Is it right? Difference in profit. How much is there? 6,000. Is that where it is there? It is happening here. It is a point number 6. Is it right? Point number C. How much is there? It is 6 million. 6 million is the difference in the profits from the previous year to current year. I want to make it. I'm trying my best. 1 minute. 16,500. Fine. Is that you don't have anything here? Just give me one. I'm just taking. Is there any alternative? $12 million. Fine. Yeah, 12 million. Fine. Plus but who paid dividends 10 cents per year? Is it who paid dividends of 10 cents per year? 10 cents per share. What is the share capital of Hoof? 100% of net assets of Foot. How much is just they have paid 1.10% on the, where is the share capital? They have Foot paid no dividend during the 7, but who paid a dividend of 10 cents per year? Okay, how much dividends they have paid? Profit for the period. Profit for the period. Profit for the period. Who issued 100 million 8% loan? Foot results are how much? This was revenue, cost of sales, gross profit, operating expenses. No. 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 Listen, Shifa.
Yes.
We will stop here, okay? We'll stop here. I will get the clarity and I will explain you, okay? Now I will refer the book. Once I refer the book, if there is anything is missing or some information is missing that I have failed to add, then I will make that and I will get back. Tomorrow we will continue, okay?
Okay, inshallah.
Okay, please. Otherwise, now we want to know the exact thing where we have. I think there is a 10%, 10 cents is there now. This 10
Yes.
cents they have paid dividends. Now we want to know how many shares are there. Is it right? How many shares are there? That is very important. Who is it right?
Okay.
100. No, 100 into 10,000. Okay, just we will stop here, okay?
Okay.